discuss that and more with Upasana Chachra, the Chief Indian Economist at Morgan Stanley. Good morning. Thank you so much for being here with us. Tomorrow is going to be the big day. We at ET Now, of course, will be live with the RBI Governor's speech. We'll get the best of economists, experts, policymakers, post all of that. In the run-up to that, what are you folks at Morgan Stanley penciling in when it comes to a rate hike? Should there be a rate hike now, given the recent action by the Fed as well? And, of course, you've got inflation coming down. What are you expecting?
Look, so we are expecting monetary policy normalization to continue. So for tomorrow, we are building in a 50 basis points rate hike. I think that's a little bit higher than what the consensus is expecting, around 40 basis points. But all in all, we've been looking for front-loaded rate hikes, which have started from the May month with the intermeeting rate increase. And we think that there is need to normalize the negative real rates that the economy is currently under in. And given that growth conditions have been improving and inflation outlook, while yes, has improved with this moderation commodity prices and better than expected trend in food prices, it still remains a bit challenging and uncertain, I would say, given all the global developments. So for tomorrow, we are looking for a 50 basis points rate increase in the repo rate.
The Reserve Bank has also been quite clear that it has no level for the rupee, but it will be coming in to rein in volatility. Channel checks does show that the forex reserves have also been used. Do you folks have any expectations of commentary when it comes for the currency, as well as the action that we've been seeing as far as bond yields go?
Sure. So I think, as you rightly said, RBI would not really comment a lot on its FX policy or on its level of rupee that it's looking to sort of target, and I think that would probably continue. So we don't really are looking, not necessarily looking for something very specific from a currency perspective. I think probably something on liquidity management and also the stance or the tone of the monetary policy will be important to give direction to rates and rupee in the quarters ahead. So if you look at interbank liquidity, it has come off quite significantly, and in part driven by all the pressures from the balance of payment side. So I think we would be looking out for if the RBI or the governor touches upon that aspect and what are their thoughts and the way forward, given the stance of the RBI has been to ensure that liquidity would be available for all productive sectors, and the moderation in liquidity would be done in a phased manner over a multi-year period. So I think we wouldn't really be looking for something very specific on this, but probably the overall tone and stance will be important for asset market prices behavior. And I think from a fundamental perspective, the fact that commodity prices have started to ease off, that should take off some of the pressure from the current account and the trade deficit, the numbers that we've seen in the past, probably that should mark the peak. And from a fundamental perspective, that should also take off some of the pressure from the rupee.
Upasana decides to do a 50, that means 35, 35, 50. That's about 120 bips, right? Won't that derail the economy? Won't demand pressure start waning back? Don't you think it will have an impact on home loans, real estate loans? Do you think if Reserve Bank of India does a 50, they would be tightening too much, considering that how commodity prices have come down?
Sure. So I think if you look at where policy rates are right now and the state of inflation and growth, and if you look at where we were pre-pandemic, so currently we're at 4.9% on the policy rate. Inflation is at 7%. Yes, the outlook has improved, but as we all know, it's pretty uncertain. At the same time, growth trend has improved quite a bit, especially from the pandemic-led disruptions when we entered these very loose monetary policy situation. So if we look at that and we then build in the policy rate increases that we are forecasting, so taking the rates to 5.4%, that will still mean that even on, say, forward-looking inflation, you'll be maintaining negative real rates. I think that in itself shows that the monetary policy is not going to be overtly tight, and it should not derail the domestic demand recovery. I think the key over here would be that domestic demand is being supported by a lot of reopening vibrancy, which has been, playing out in the last couple of months. We're seeing very strong growth from the consumption, especially the services side consumption of the economy, and also some of the reform measures that the government has been taking in the last 2 to 3 years will start to play out, and they're already showing some signs of improvement with some nascent improvement in the capex related indicators. So I think the economy will be able to absorb some of the this increase in real rates that is happening, given that growth has improved. And I think if we take into account inflation, this trend is not really going to, in our view, lead to an overtly tightening stance from the Reserve Bank.
Upasana, appreciate your time. Good to have you on ET Now.